first quarter. Now we in the fourth quarter, man.
Welcome to the fourth quarter experience. These are your hosts, Sid and Siraj, and producer Pablo, aka Pilot Pablo, is behind the camera. So thanks for fastening your seatbelts. Should be a good show.
Oh, great show. There's a lot of awesome stuff that's happened.
I mean, we had a pretty cool week, right? We met Alexis Ohanian, founder of 776, co-founder of Reddit, founder of Athlos.
Founder of Athlos.
A pioneer in the women's sports space.
Absolutely. I think that's the best way to say it is the F1 for women's track. We actually went in October. I'm forgetting what
Icon Stadium.
Icon Stadium
in New York.
It was sold out. It was actually by far some of the most excited fan base I've heard. I would say the other one that's comparable is IDL. Like the amount of screams that we were hearing, it was like unbelievable. But I think that he's doing more events. I think one is in New York. Now I think they're going to London. So pretty exciting.
So they're expanding to a 2-meet championship format, increasing the total prize pool to $2.1 million.
Okay.
And winners can also get equity in the league itself.
Oh, that's sick. I did not know about that. And the Tiffany tiaras.
Yeah, Tiffany tiaras, which Tiffany's a partner sponsor for the show, or their programming, obviously, the league. But it was really cool. We met Alexis at a gallery event for Athlos, where I believe they were taking these pieces of art, these photographs, and selling it to the public.
It was like an auction. You put in a bid. I think all of it goes to charity.
Yeah.
To support women's track, actually. So it was quite awesome.
It was awesome. I mean, the fact that we met Alexis and we've seen his email since the early days of the fourth quarter.
Yeah, he was an early follower of our newsletter while Sid and I were doing our corporate jobs.
Yeah, and then
writing this on the side.
When we introduced ourselves, he's like, "Oh, you guys are the fourth quarter. Love what you guys are doing. Some of my favorite sports business content." So it was honestly really hyped to just meet him.
Very hyped. Also, the compliment means a lot to us.
Yeah, so. He had some praise for us. I think there's going to be inevitable future overlap. Super excited for Athlos, everything he's working on.
And Alexis, you're always welcome to come on the show and talk about what you're doing in sports.
Yeah, I'm sure we'll have you on soon. But yeah.
What are we talking about today?
Okay, so right in, we have a pretty interesting. I thought it was when I was doing the research initially, I thought it was going to be a pretty slow week, and then it started picking up, and I was like, oh,
it really picked up yesterday. Yeah, I feel like.
And this morning, I thought we would be, especially in the new fund alert section, I thought our streak would expire, but we got a buzzer beater, so it should be an interesting one. Headline story: billionaire Tom Dundon bought the NBA's Portland Trail Blazers for $4.2 billion last month. He just laid off 20% of the team's workforce on the business side. Should be interesting. In the cultural zeitgeist in sports, former NBA player Tristan Thompson said he was an equity investor in Anthropic on Market Bubble, the prediction market podcast hosted by FaZe Banks and crypto trader Ansem. Producer Pablo, where is the cultural zeitgeist? There we go. I thought I missed it for a second. In team and league news segment of the show, pretty interesting stuff, okay? So China and FIFA were about to have a blackout and not air the World Cup in China because FIFA was essentially asking for too large of a price. China state broadcast, it's a single bidder.
CCTV, right?
Yes, they don't have any competing bidders. China's not in the World Cup. Their time zone difference, so it's actually being aired from like 12 a.m. to 6 a.m., which is like when everyone's sleeping in China. And FIFA wanted $300 million. China said, no, 60 million, take it or leave it. They ended up settling on the 60 million. 60? So fraction of the price. We'll get into that. There was an interesting equity research analyst, David Joyce at Seaport Research Partners, who covers the MSG Sports public stock. And he basically said the Knicks' insane playoff run is about to probably bring them $140 million in gross revenue.
Really?
Which is wild.
Is he predicting that they go to the finals too?
So if they go to the finals, it's $180 million.
Oh, okay.
Okay, so
I mean, after game one, it looks like that's probably what's going to happen.
So I have a breakdown of how much for each round of the playoffs that they were making for home games. So it's pretty interesting. And we're doing a new segment, a quick rapid fire. There was 3 NFL team ownership transactions. So I'm just going to recap all of that in a rapid fire. In the world of sports real estate, McDonald's, the largest food chain in the world, just bought its first naming rights. The Chicago Fire's MLS team, new $750 million stadium in Riverfront Grounds, opened 2028, and it's called McDonald's Park. Pretty cool.
Pretty cool.
Yeah. And
this is their first naming rights too.
Yeah, first.
They haven't done this before. Okay.
Yeah, and they're the largest fast food
fast food
in the
chain
world.
in
You would
the
have
world.
thought
Yeah, you would have thought they would maybe be tapped in.
I mean,
like
there's
that.
McDonald's All-American, right? So they've done stuff in
they've done
sports.
but that's like youth sports. I mean, that makes sense. Like you're tapping into families. Hey, after McDonald's All-American, why not grab some McDonald's after the game, right? But
Yeah. So there's actually a marquee McDonald's in this stadium as well. So pretty interesting stuff. I'll get to it. In our M&A investment section, two pretty interesting pieces of news. PSA, one of the largest names in the trading card industry and grading industry, just got a $200 million injection of capital from its parent company Collectors, which is pretty interesting. The sector is exploding. A lot of interesting things in the works for PSA. And senators just introduced a bill that'll ban private equity from investing into the $40 billion youth sports economy. I don't know. Is that good, producer Pablo?
I don't know. I mean,
we'll
I don't
see.
know what your stance is, but I might be the devil's advocate here.
Okay, well, I'm not saying that it's a good or a bad thing. I'm just saying there's a thing. And this is the second time we've seen Congress try to make a stance against kind of the wealthy in the sports business space. We had the Home Team Act just a month ago, right, that Bernie Sanders introduced, basically allowing, just restricting ownership, kind of billionaires and billionaire teams to just buy sports teams and just move them to a different
No, 100%. And honestly, like, especially Bernie Sanders being a senator from Connecticut, I mean, he might be a little bit salty that they lost the Connecticut Sun. And
to the Fertitta brothers, right?
Right, and now it's in the Houston Comets, I believe. So
something like that.
Yeah.
Okay, so another new fund alert. Shamrock Capital closed its fourth content strategy fund, fourth fund, Content 4, at $813 million in commitments. Insane, oversubscribed in a month, and it will not in a month, in 3 months, excuse me. And just about it's over with $700 million target, which seems like well-performing. People want to contribute and be a part of this.
Yeah, absolutely. So Shamrock, just for reference, the main focus is their content strategy lever. And so what they're doing is they're buying IP, generational IP across entertainment, music, and sports. And obviously there's, long-term recurring cash flows that comes from royalties, but we'll dive into a little bit more.
Yeah. In the world of emerging sports leagues, the PWHL is continuing to be on a rocket ship. They just announced their fourth expansion team in the last month, San Jose being the most recent. So we'll get to it. I mean, we posted about this and it was going nuclear, but we'll touch on that. There seems to be a lot of fans for the Professional Women's Hockey League, one of the fastest scale-ups in all of sports. Industry spotlight. If you've been anywhere online in the sports business space, you'd see that there's been one name that's been tweeted about thousands of times. Stan Kroenke. He is the billionaire, mega, I guess, sports owner, right?
Mega sports owner, mega sports billionaire, mega sports landowner, everything.
The Rams, Arsenal, the Nuggets, the Avalanche, just a lot. People have been just highlighting his $23 billion portfolio because Arsenal just recently won the Premier League.
Yeah,
so,
congratulations to all Arsenal fans.
Yes, not that he needs a shout out.
You guys almost lost it, but you held on.
Yeah, so he's in our industry spotlight. In startups and technology, Arsenal Football Club just launched its first ever diamond collection, and it was done in partnership with a startup called Brillianto, a Spanish lab-grown diamond company. And they've turned basically the football's home turf, like the grass turf, into wearable, ownable IP. They turned that into diamonds. Isn't that wild?
That is wild. And it's like fully like branded as Arsenal. I think they have the cannon on it too, across the necklace, across the cufflinks.
Yeah, so that's what we're going to talk about in our startups and technology section, because I thought it was a quiet week and that one was just kind of blown out of the water, because I think that's pretty interesting. In cool partnership news, Fanatics and Amex just announced a groundbreaking partnership. Amex just became the official payment partner across Fanatics. A lot of interesting stuff there. They've been doing this stuff for a while. Fanatics is launching a credit card later this year with Amex as a key partner. And we're ending the show with Professor Paramanu.
Professor Paramanu back in the cut.
AP prediction markets. So you're going to be demystifying the space, making sure people are smart and caught up to news.
Class will be in session in probably around 40 minutes.
Okay. Love it. So I'm going to just dive right in. Headline story, billionaire Tom Dundon bought the NBA's Portland Trail Blazers for $4.2 billion last month. He just laid off 20% of the team's workforce. So some reports say 50 long-term employees. Some get as high as 70. Just a few things that people are
Yeah, because he's done some other stuff as well.
Yeah, so he decided to cut the budget for free T-shirts during Portland's 2 home playoff games against the Spurs. The Blazers were also the only playoff team that opted not to bring their two-way players on the road with them. Dundon claimed a hotel didn't offer late checkout and asked him to pay for another night, which he did for players and coaches, but not for the rest of the team, the traveling party, because the checkout was at 1 p.m. and there was the staff were due for a lunch in the ballroom at 1:45, 45 minutes later anyway. Honestly, I think this is valid. Like, you're checking out in 40, you have to be somewhere else in 45 minutes anyway. Why would you extend?
Like, why would you want to pay a late fee, right?
Yeah.
For like no reason.
Yeah, I mean, I completely get that. And then also, this is kind of funny. Dundon may target the team's mascots. So I didn't know this, but the Trailblazers have two mascots. It's Blaze the Trail Cat and Douglas Fir. And he was like, why do we basically need two mascots? So I want to talk to you about why Tom did this. There wasn't any particular reason talked about. You wrote our article this week for the fourth quarter newsletter about it.
Yeah, because I thought it was interesting because, I mean, these are like a lot of moves that he's made in the past like 2 months, right? His ownership, I think he got ownership beginning of April.
Yep.
Right? So all these moves have happened in the span of, let's say, a month and a half.
Mm-hmm.
At the same time, they were in the playoffs when he made these moves. You're going into the offseason. There's a lot of like speculation about potentially him moving the team to another city. There's
Where did they say he was? They were moving the team to?
I don't know. There's probably some spots. I think it was somewhere maybe. Honestly,
all right, yeah. Okay.
I don't know,
it's
because
currently
at the same
in Portland.
time, it's not going to be in Seattle or Vegas because those are expansion teams. But I mean, any other city that like he thinks is a bigger market, that's a big concern.
I mean, he owns the Carolina Hurricanes NHL team, right? So he's like a Carolina guy.
Yes, but I think he's originally from Texas. I could be wrong,
Got
but
it.
what he was saying was that when he actually bought the Carolina Hurricanes, there was the same concern about him moving the Carolina Hurricanes to Texas, and so that ended up not happening. Carolina Hurricanes actually ended up performing pretty well under his tenure. So,
and people don't know this. He did this very similar thing when he bought the Hurricanes as well. He did some cost-cutting measures as well. So this is not
absolutely.
a new concept.
Yeah, he's like, okay, so this is what I think is that essentially he's very much obsessed with efficiency.
Okay.
And I think that's like the natural course that we're going to see in sports long term, especially in U.S. sports. And there's a lot of different things that we can talk about here. I mean, first of all, let's talk about the fact that his Dundon Group and the people that actually are in the consortium of investors, they include executives at Panda Express. At the same time, the people that started Blue Owl Capital, all of them have been in the investing and operating space,
private equity space,
exactly,
as well.
Right? It's not like this fundamental transition of ownership in the last like 2-3 decades, where experience is more not related to the private equity space and like, hey, the playbook that they want to use. And so that's kind of changed. And I think Dundon is, exhibiting that with all the moves that he's been making.
Yeah, he's pretty unapologetic about it too. But here's what I think, right? It's one, a cultural reset. I think he's just like, this is what we're doing. I think he has a background in private equity as well.
Yeah.
And he was like, if there's inefficiency, we're going to trim it. So that's what I think. And then also, you brought up a good point when we were discussing this yesterday, but there's an uncorrelated cost logic where most of the money and valuation in these sports teams is tied to the media rights, right? That's kind of one of their main revenue drivers. And having more corporate staff doesn't really correlate to that money making. So yes, it's not as, even if you trim, I believe, if you're just doing some quick math, 70 people paying them $100,000 average salary, that's 7 million people.
$7 million, yeah.
70 million. Still like a rounding error. But so wait, 70 million?
7 million.
7 million.
Yeah.
Sorry, 7 million. I thought I said 7.
But at the same time, like these are people that have been in the organization for a while, is my guess. And so, that can compound. The way that I look at this is I completely agree because, I brought that up with you. I was like, look, a lot of this value that comes with all these sports teams, especially with private equity investors, and now they're evaluating these sports teams, they're able to invest through, these minority stakes that are popping up, and the leagues are allowing this capital to come in and provide liquidity to owners. And what they're looking at is, look, the media rights deals are massive. They're extremely lucrative. 76 billion over 11 years for the NBA, and all of that is uncorrelated to all these employees who either work on ticket revenue or sponsorship deals. None of that is actually related to the annual league distributions, like you were saying. And so that leaves them a little bit vulnerable, especially if owners are looking at this and saying, hey, look, we want to make our team not only the most winning team in the league, but at the same time, very profitable. And so I actually had Index look through the finances. Actually, a lot of this is publicly available, the operating income and revenue across the NBA. And this was based on recent 2026 valuations. And what they were saying is that if you look at it from an operating margin perspective, the Blazers ranked 25th out of 30 teams. So they're bottom quartile when it comes to how much money they're actually extracting from, top line revenue. At the same time, there was actually, according to the Oregonian, there was like an interview with this like Oregon newspaper, and said a high-ranking official in the Blazers organization said the franchise had become one of the largest organizations in the NBA, which is an unsustainable reality considering they fetch the league's lowest sponsorship revenue and rank near the bottom in ticket revenue.
Wow.
So It might be a thing where it's like he just feels that it's too bloated right now and they're not getting as much money as they should be given how many people are employed. And I think he went and said, hey, look, we're going to cut a bunch of people.
So that's interesting. I'm also curious, one, he hasn't publicly said this, but what AI might come in, operationalize and efficiency, kind of optimize that efficiency within the business side and biz ops. We'll see what happens or what he uses, or if he's even thinking about that. The second, I think, is as private equity money and ownership comes into the NBA, is this setting a precedent for private equity who might have board seats or a seat at the table saying, we need to start rethinking how bloated our organizations are? Do you think this is something that might happen?
I think possibly because, look, their returns hinge on these investments. And so if they're looking and saying, hey, look, there's actually a chance that these sports teams can become profitable long term, and that actually drives the value of the business other than these lucrative media rights and the trophy asset value, then I feel like that influence will actually make a direct impact on how sports teams operate long term.
Yeah.
But one thing that I will say, and this is like an interesting question that we can leave off of, is at the same time, what Dundon did might make sense, but doing it so fast can alienate fan bases.
100%.
You might be like, I think he also was, he laid off people that were in the content, like local content space. So people have actually built a natural affinity to these people that might have been reporting on the Blazers for, decades. And at that same time, you could be alienating the fan base because they're beloved to them. And so that's going to be extremely important. At the end of the day, it's sports. You own teams to win. You do it for the fan base and you do it for the city. So you got to make sure you strike that balance between, being a profitable business and at the same time caring about winning and doing it for the fans.
100%. Moving on to the cultural sports headline. In the cultural zeitgeist, we have...
Cultural zeitgeist?
We have former NBA player Tristan Thompson. He went on the Prediction Markets podcast, Market Bubble, which is hosted by FaZe Banks and crypto trader Ansem. And he basically said he was an early equity investor in Anthropic and brought a bunch of his fellow athletes into the deal as well. And it was super interesting. For people that don't know what Anthropic is, that is the company behind most people's favorite AI right now, which is Claude.
Yeah.
Okay, some secondary markets are valuing the company at $1 trillion. Tristan, for more context, made a little over $125 million in his playing NBA
Honestly, the
career.
Cavs did him right with his contract.
So it's cool. You would have never thought some of these players have
access to Anthropic out of all.
Or interest in stuff that's like super AI or tech, right?
Yeah.
And we were talking to Scott Soshnick at Sportico. We got coffee with him earlier this week. And he said that there are a lot of, there is just interest in locker rooms now of these players, right? That are just talking about deals, investments and stuff. So it seems like a pretty interesting trend. We were at, NFL Biz Week at RAM with a bunch of NFL athletes that are interested in the business space, investment space. It just seems to be a growing theme. I actually was speaking to a gentleman yesterday. I want to pronounce his name right. Jeremy Ebombwisi. I don't even
know how it's spelled, so I don't know if I can correct.
I need to ask Jeremy. Well, I had a great conversation with him yesterday. He is a player for Los Angeles FC, the MLS team, and he has a huge interest in investing in the space as well. And it's like, our friend of the pod, Jack Scahan, another professional soccer player, MLS soccer player for San Jose Earthquakes. We know even the athletes that we know, they're super interested in this cultural zeitgeist. So I think it's fascinating.
Yeah, I think it's also about like navigating who you know, and at the same time figuring out what doors and what tables or what dinner tables you need to be at, right? At the same time, a lot of these deals happen closed doors. There's gatekeepers, especially when it comes to VC, where if you're investing through an SPV, which is what Tristan Thompson did, you need to know
special purpose vehicle.
Special purpose vehicle, exactly. So in a way, you don't have to directly invest into a company. You can invest in an SPV, and at the same time, the like investment dynamics is similar to just a very, very small fund, where yes, you basically get access to carry. Or you don't get access to carry, but you get access to the 80%, 80-20. I don't want to get into that.
Yeah,
but anyways, it's just look up SPV. It's a good way to actually get access to deals if you're an athlete. But there are gatekeepers who are actually rolling up those SPVs. And so getting in on Anthropic early was actually really interesting from an SPV perspective, because now if you try to get an Anthropic through an SPV, they actually just, I think, sent out a memo that said, if you're using because there's now like
certain platforms
where it's like SPV on top of an SPV, all those investments are void. So they're actually devalued to nothing.
Which is wild, right?
But Tristan came in super early. So he's about to make a lot of money, especially if they IPO at $1 trillion price tag.
Yeah, shout out Tristan. Just to recap, or just to cap this, you said a very interesting point. A lot of these things happen at dinners, closed doors with the right people. So he credited a buddy of his in Silicon Valley and at NBA dinners, helped him and around road games when they played the Golden State Warriors in San Francisco, where he sat with tech insiders picking their brains about the future of AI. So that's awesome. I love hearing these stories. They don't always come to light. So
okay,
I think it's awesome.
I have a good question for you.
Okay.
So All-Star weekend happened in SF a year ago. Okay. In SF. Super Bowl just happened in SF as well.
Mm-hmm.
How many VC deals that athletes actually got access to do you think happened on those 2 weekends?
So many.
Many?
Even if it's probably not at that exact moment, but there was probably
But you had that week of like people there that are
everyone
hanging out.
meeting each other, those conversations prolonged, follow-ups. Yeah, I mean, for sure. I think hundreds of great connections and relationships built for sure, at least.
Hundreds of millions of dollars probably were being made at that at both of those events, just given the investments that they made, especially when it's related to AI.
Yeah, I agree. Well, shout out to them, and shout out Tristan for his early investment in Anthropic. Okay, team and league news. 27 days before the biggest World Cup in history, FIFA was staring down a black hole and a blackout in China, where 1.4 billion people were not even about to see the world stage of soccer that was going to be played. So FIFA eventually caved and signed with China's state broadcaster for a reported $60 million. Okay, it still sounds like a lot, but listen to this. After originally FIFA asked $300 million, so that's an 80% haircut. So kind of surprising. FIFA had reportedly sought $250 to $300 million on the media rights that they were going to sell to China.
Which makes sense because you're essentially
Huge
distributing
market.
to 1.4 billion people.
Wild, right? And then they dropped it to 120 to 150, supposedly 150 million. And then before settling around the 60 million mark. So here's why, right? One, there's only one legal buyer in China, which is by Chinese regulations, the CCTV, which is Chinese, it's under the Chinese media group, Chinese state programming essentially, and they're only allowed one negotiator to purchase the World Cup media rights. So there was like no bidding, right? They're like, this is what we're paying, take it or leave it.
They have like full buying power.
Exactly. And a couple other things, right? So like none of these other big Chinese media companies like Tencent could have purchased this. So there was no one to bid CCTV up. But here's why, right? One is China is not in the World Cup this year. So from a national perspective,
like, are they really going to tune in?
You don't really have a horse in the race. Okay.
Yeah.
But so what? Soccer's still soccer, football's still football. FIFA is the biggest, World Cup is the biggest stage for it. But it is the worst time zone because it's being played in North America. The time zone that it's going to be aired in China is from 12 a.m. to 6 a.m. And that's like a dead zone for advertisers. That's when everyone's sleeping. So that's basically what China was essentially trying to say, that like this is not an ideal time slot for us.
Exactly. And like in reality, there's 1.4 billion people, but how many of them are actually going to tune in from 12 to 5? It's going to be the diehard fans. And let's be real, like, how do you even quantify that? And so I think FIFA was coming in a little bit too hot. $300 million makes sense from, like, just if you look at it on aggregate. But I think when it comes to the time zone difference, the fact that there's only one broadcaster and it's owned by the government, let's be real. Honestly, you guys got to take the 60 million.
Yeah. I mean, they did. So.
Yeah, they did. And but there's still India left, right?
Yeah. So India's the bigger story now. So this deal leaves India the only other major market still facing a potential blackout. So FIFA wanted 100 million. JioStar, one of the big media companies in India, reportedly offered 20 million, and Sony walked away. So are we about to see like a similar situation?
So India is more interesting because at least it's not government owned. You have two players in the market. You have Sony and then JioStar.
But Sony walked away. So there's like
now it's really just JioStar versus. And so there's actually a good reason for this. Right now, JioStar has a massive deal with the IPL. They're paying basically $1 billion a year to have IPL rights, because if they don't have
the Indian
IPL
Premier
rights,
League for cricket,
Indian
right?
Premier League, it's like by far the biggest sport in the world by just the amount of viewers that they get. And so
five times the viewership of the Super Bowl.
Yeah, concurrently, exactly. And so IPL is huge. And honestly, if you don't have IPL, especially if you're JioStar, you're going to lose a lot of your viewers. And so they have to have it. But at the same time, they're losing so much money off those deals, right? Over I think like the last media rights cycle, they lost it was about 1.5 to $2 billion that they lost.
Wow.
In value, because like these contracts aren't actually in the benefit of the distributor or the broadcaster, but they need to have it because if you don't have it, you're not going to get the viewers that you want, right? Like everyone's going to go to your competitor. And so they have that power, but at the same time, it kind of hurts other sports properties that are trying to get media rights. I remember we were talking to Raj, and right now,
shout out Raj
Shakuri. So his family actually owns the Goa Guardians, and so
a professional volleyball
team within India. It's emerging, but they actually get a lot of viewers. They're, I think, going through just digital streaming on YouTube, and what they were saying is that it's really hard to negotiate contracts with broadcasters in India because they're getting essentially squeezed by IPL. So it makes sense. I think there's a chance that FIFA might not even get the price that they want. They actually just walk away because they're like, look, what's the point of, setting the precedent of only a $20 million deal when maybe a few years later, maybe there's new players that come to the market. The landscape of India's, digital viewing broadcasting streaming platform changes. And then FIFA World Cup 2030 comes along and you can actually sign a $50 to $100 million deal.
So I agree with you, but I don't think FIFA is going to walk away. I mean, it's still $20 million that's on the table. Supposedly during this 2023-2026 cycle within FIFA, they're expected to make like $13 billion in this like World Cup.
That's like a drop in the bucket. $20 million is like...
Yeah, but it's still like, I feel like what we're seeing here domestically in the States is they're trying to squeeze every dollar out of the fans and kind of this opportunity that they're hosting in the commercial capital of the world, right? So like, I feel like for this stretch, they're like, okay, yeah, we'll take $20 million. I don't know. I guess it's not significant how much they're making, but still.
Yeah. And I think it's like maybe you just sometimes got to play hardball and you say no. And then a lot of people in India are pissed off because they're like, there are actually a lot of soccer fans in India that want to watch FIFA. And so, I don't know. I think they should walk. 20 million is way too low. IPL deal is $1 billion a year.
Yeah, but you're still reaching, it's not just a pure dollar amount. You're reaching that billion people. That's still huge, right? That's what we're saying with the China situation. It's not just pure number. It's also that you're reaching.
But you're getting less than China, and I guarantee you, India's got way more soccer fans. I feel like.
I actually don't know. I mean, maybe.
Honestly, I'm just judging this anecdotally. Like
anecdotally.
I'm not gonna lie. Like all my cousins in India like love soccer. So
yeah, no,
like,
I mean,
and they
I
watch
agree
like
with that.
English Premier League like all the time. They're big Man United fans. So like. That's honestly what I'm really basing this off of, but I'm pretty sure soccer is really big in India. Like, I think they need to figure out a way, especially the broadcasters, to work with FIFA.
Yeah, no, I agree. I tend to believe you too. But in other team and league news, the New York Knicks are on a historic playoff run right now. Okay, but we're not talking about that. I'm talking about all the capital and the financial economic results that are coming from this. Okay,
yeah.
Pretty fascinating. So there's a gentleman named David Joyce. He is an equity research analyst at Seaport Research Partners, and he covers the MSG Sports public stock and he put out some stuff. This was picked up later by Kurt Badenhausen at Sportico, and essentially the New York Knicks could make $140 million in gross revenue through this playoff run. And if they go all the way to the finals.
On the playoff run alone.
Yeah. And then if they make it to the finals, they can go to $180 million. So here's a couple things. So here's the per game ladder, right? So this is all from Joyce. Gross revenue, including tickets, suites, concession, merchandise as well. So in round 1 for each home game, they made roughly $8 million in gross revenue, okay? Okay. Round 2, they made roughly $12 million, and they swept the 76ers 4-0, right? The conference finals, which they're currently in, they're projecting $17 million in
per home game
in gross revenue. And if they make it to the finals, roughly $20 million per home game. Obviously, that hasn't been finalized yet. That's projected, but that is wild.
Yeah, wild. Honestly, the shareholders should be, rooting for the Knicks to drop a few away games, so they get that.
They come back at home. Yeah, that's funny. So the NBA historically keeps 45% of playoff home ticket revenue, but in 2016 they cut that to 25%, so more margin going back to the teams themselves. So Joyce pegs the Knicks' profit margin on playoff revenue at 55%.
Wow,
kind of wild.
That's pretty good.
And just for more context,
especially for a sports team that's like really, really good.
Yeah, no, I agree. And for more context, last year the Knicks generated about $115 million in total playoff revenue. So already they're projected to surpass that rate, which is wild.
Wow. This honestly might be the Knicks year. They're doing the spinoff too, which I think you're going to touch on.
Yep.
At the same time, they beat our beloved Atlanta Hawks. So
I don't want to talk about that.
I'm not.
That was a little.
I know.
Producer Pablo, that was vile.
That was vile. But I'm not going to lie. Shout out to the Knicks. They're crushing it. Game 1, that comeback was unbelievable. And so, honestly, it's going to get the crowd more riled up. Ticket prices, I swear to God, are going to just shoot up. And so, at the same time, the shareholders are going to benefit from this. I actually just checked the stock price for MSG Sports. They're up 36% year to date. Obviously, that could be about the playoffs, but I think it's most importantly about the spinoff, which I'll let you talk about as well.
Yeah, I mean, just really quickly, just giving an update because, we heard a couple months ago that the MSG Sports was planning on spinning off the Knicks and Rangers.
And if you want to read more about it, you should check out our newsletter where I broke it down.
You did a great analysis on it. So they were basically pitching the concept to the board where the Knicks and Rangers were about to be 2 separately traded public companies. This past Monday on May 18th, MSG Sports filed a confidential initial Form 10 registration statement with the SEC to spin off the Rangers business into a separate public company, leaving a standalone Knicks company. So for some context, according to Sportico's valuations, the Knicks are privately valued at around $9.5 billion, Rangers at a little over $3.6 billion, and a combined $13.5 billion, which is 48% above MSG's current enterprise value. So unlocking true shareholder value by spinning off these 2 assets, I think it makes sense. We'll see what happens. It's an interesting story. We'll continue to track.
Yeah, and so just to give a quick update also to viewers and also just the way that I'm thinking about this. So a lot of people ask, like, why is the market cap so different from the actual private enterprise valuation? And a lot of it has to do with the fact that there's a opacity in the actual reporting. So if you go on to MSG Sports Investor Relations, you actually don't see the split between what the Knicks are making or the Knicks' P&L and all their financials. And at the same time, you don't see that for the Rangers. So it's actually really hard to do your due diligence on seeing the value of both properties. At the same time, there's a big concern for private equity investors or institutional capital that are trying to deploy money into sports. It's tougher to invest in something that's bundled together, right? What if you're a private equity firm and your entire strategy is investing in NBA sports teams? And now you have to get some exposure in the NHL. You're going to pay a discount on the price because you don't want the Rangers. You just want access to the Knicks. So if you spin those 2 off, it actually opens the doors for minority stakes to come in from big pools of capital. And at the same time, it provides liquidity for a lot of the shareholders. So I think when you see the spinoff actually happen, both teams, when they're valued in the public markets, if you combine the 2, will equal the private valuation. And we see this with the Atlanta Braves, right? Their private valuation is pretty much close the same to their public valuation. And I think that'll happen after the spinoff.
Good point. Give me your gut reaction on these. We don't have to analyze them. I'm just giving you a rapid fire. The NFL was on fire this past week with team ownership investments, okay? So there's 3 main ones. I'm going to run through them. You comment wherever you deem fit, okay? And if you don't have
love commenting on stuff.
And then if you don't, just be like, no, nice, and keep going.
All right, let's do it.
Okay, cool. First, Hollywood's most powerful agent just bought into the Raiders. Ari Emanuel and Mark Shapiro, the legend business partners behind Endeavor, one of the biggest talent agencies in the world, just bought a minority stake in the Las Vegas Raiders. So Ari Emanuel is at 1.4%. Mark Shapiro is about 0.6%. They're co-investing alongside Egon Durban, who's the Silver Lake co-CEO, which is one of the largest private equity firms.
He also led the deal when Silver Lake bought Endeavor, so they're actually like all pretty close friends.
All business partners too. And so Egon is raising his stake to 22%. He's a pretty large shareholder. Michael Meldman, who is the co-founder of Casamigos Tequila, is to increase to 12.
Isn't that George Clooney's tequila brand
and The
too?
Rock.
Okay.
Yeah,
I didn't know The Rock was in that.
So to 12.9, producer probably, you should double check that, but I believe so. And he increased his stake to 12.9%. Joseph Barada at Blackstone to 1.7%, and Michael Dell, as in Dell Computers, was also part of the deal. So pretty interesting. The 6 investors now hold a combined 25.3% at a $9.9 billion valuation.
Wow.
Mark Davis is the current majority shareholder. He owns 36%. And here's something that's interesting. So there was reports saying that these are personal stakes and they're separate from TKO, WME, Mari.
Yeah.
So kind of cool.
Which makes sense because when Ari Emanuel was at the All In Summit, he was essentially saying that the TKO strategy would never look at like buying minority stakes in some of these major leagues. He sees that the profit potential for businesses like the UFC and WWE, where there's a lot greater cost control. At the same time, there's a lot more operational control because it's not franchise based, right? They're individual athletes. He likes that business model a lot more. So it makes sense that he's essentially distinguished the two and he's going to personally invest rather than like having TKO do that, which I think would make no sense. But it's crazy. Raiders are worth $10 billion.
That's
and
wild,
honestly,
right?
They haven't been performing that well in the next 2 years. So hopefully Mendoza actually turns this ship around. Him and Tom Brady. Also, Kirk O'Chains is there. Let's see. I mean, fireworks are going on financially. Let's see if it happens on the field too.
It's also funny in Entourage, the hit TV show, Ari Gold, which is a reenactment kind of representation of Ari Emanuel. Remember that scene or that episode where he tries to bring a football team to Los Angeles?
No, I didn't.
There's an episode
of that?
where he's
Okay.
like trying to spearhead an ownership group into.
Oh, really? Okay.
So
I
can't believe it
gotta
got
rewatch
manifest.
that
Yeah,
episode.
that's crazy. You don't know a ball like that. But anyway,
I literally put you on Entourage. That's crazy work.
okay. Well, anyway, you're right about the fact that the Raiders are worth $10 billion because this one might be even crazier. So the sports private equity firm Arctos just took a 3% stake in the Browns at a $9 billion valuation.
$9 billion
Wait,
valuation.
the Browns
The
out
Browns?
of all teams. So Arctos ultimately is expected to reach 10%. So this is kind of the first tranche of their investment. Browns are the third team that Arctos has a stake in the NFL. It's joining the Chargers and the Bills. And proceeds are going to go towards the new Huntington Bank Field in Brook Park, $2.6 billion dome stadium, opening up to 2029. Haslam Group, the Haslams have pledged a little over $1.7 billion of the cost as well. So pretty cool.
Yeah, I mean, I think it makes sense. That's like, hey, look, we actually need to use this cash operationally to build out a stadium. Arctos, that's literally their bread and butter is to provide liquidity to owners so they can reinvest into their sports team. So makes sense. Browns at $9 billion valuation is pretty wild. But let's be real. These NFL teams are going to continually go up. They're also just masters at figuring out how to extract as much value from their media rights as possible.
Yeah.
You're seeing Roger Goodell cooking up a lot of deals with Netflix and, at the same time balancing negotiations with broadcasters as well. They're also expanding internationally to 16 games at some point. And once you're essentially an international product, the media rights deals that you can broker, it's going to bring a lot of value. And I think they're just, Arctos is just getting more exposure, right? It's 2 teams, 3 teams. They're honestly just all investing in the NFL.
Yeah. No, I 100% agree. And the last one is a Wall Street billionaire is quietly selling his slice of the Washington Commanders back to Josh Harris because his day job might be in peril. We don't know that for sure, but that's what the headlines are saying. Doug Ostrover is the Blue Owl co-founder and co-CEO, and he's selling his remaining Commanders stake back to Josh Harris's led group. So for some more context, Blue Owl, publicly traded company with the ticker OWL, which is kind of cool.
Yeah.
So it's aside. Their stock is down roughly 60% from January 2025's high of $25. Now it's around $11 amid a private credit turbulence and kind of war that's happening. We've been covering this obviously, and Ostrover's net worth is around $2.2 billion, down from a peak of 3.3. I don't think this is why he's selling his stake, but it's just interesting that it's another transaction that's happening in the space.
Yeah, I mean, think about it. For a lot of billionaires, your valuation is tied to like it's not hard cash, right? It's tied to maybe an equity stake or into real estate, right? And so, at some point in time, you might just want to liquidate. Also, you might want to liquidate because maybe you want to invest in another, sports property in the
or
NFL.
property in general.
Or
that's
property
not
in general.
Sports.
Yeah, exactly. Like you want to continually diversify. So I think it makes sense.
Also, for the record, I think he's doing just fine. He's got a lot of dough.
100%. And also, like the private credit thing, it all has to do about like software. They were by far the biggest lender into software companies, and that's been an issue because now with the boom of AI, people think that AI is going to essentially replace software. That's a whole debate that honestly, me and Sid will maybe talk about that, not on this podcast.
Yeah, I mean, maybe eventually, but that's something
if it's related to sports, like if it's some sports software company.
But we talked about it off the pod. I feel like decent. But okay, so this one's pretty cool.
Wait, I just wanted to add.
Producer Pablo. Okay.
Yeah, The Rock actually owns Terramana Tequila.
So I was wrong.
Yeah,
okay, so who owns
George Clooney.
George Clooney,
just George Clooney.
There might be other investors, but
no, but it was
believe
also
the
Michael
branding looks very similar, so maybe that's where the confusion came in.
Oh wow. Okay. All right. Well, my bad.
But Michael Meldman is the co-founder, right?
Yeah.
Okay. Of Casamigos.
Okay. So George Clooney, you're right, not The Rock. Wow. All right. Producer Pablo, you're gonna have to throw up a thing saying we corrected it later when I bring it up, because people are gonna go 4 minutes just being rage baited, like that's wrong. And then
well, honestly, maybe you were just out and about and someone was just like, yo, like I'm drinking The Rock's drink, and it was like Casamigos, and they had no idea what they were talking about.
No, I clearly just messed it up on Google or something. Producer Pablo, you were saying something?
Yeah, I just wanted the rapid fire to end before I butted in.
Love it. Okay, cool. This one's cool. In the world of sports real estate, quick one for you. McDonald's just bought its first naming rights, and not a restaurant inside one, the whole name. The Chicago Fire's MLS team is launching a new $750 million stadium and riverground property that opens up in 2028, and it's going to be called McDonald's Park. And the first time the largest fast food chain in the world has put its name on a major American sports stadium, and they won't say what they paid either. Normally, some things come out of how much these deals are.
Yeah.
So either it's a steal or no one really wants to talk about how much it was. And it was privately funded by the Fire owner, Joe Mansueto, who's funding the $750 million stadium. It's located at the 78, or in the 78. It's a 62-acre riverfront development by Related Midwest in the South Loop, just south of Roosevelt Road. I actually don't know Chicago well, but I'm going to it. Like going to Chicago in 3 weeks. Designed by Gensler, seats about 22,000 for soccer and 31,000 for concerts, which is pretty interesting. Not as big as NFL stadiums, that's for sure. And groundbreaking was March of this year, and targeted opening for the 2028 MLS season. It's described as the first major pro stadium built in Chicago in 30 years.
Really?
Yeah.
And it's McDonald's that's leading the charge.
Yeah.
So, okay, random theory, but do you think that they didn't reveal what the actual agreement was, because there might be some like backdoor like food manufacturing within the this is gonna sound weird, but like how there's like a bunch of white label like restaurants in stadiums,
Okay.
right? And it's usually like chicken wings and fries,
Sure.
which like McDonald's can just make.
So you're saying there's
But,
going to be vendors in concessions not labeled McDonald's.
that's
but
really
their
just
food
McDonald's
is-
food, but then it's also priced like so expensively. Like honestly, like other than Mercedes-Benz, like you're dropping like $20 for like chicken wings and fries, or if it's just McDonald's chicken wings and fries, because there's a McDonald's restaurant, but like no one's going to be buying $20 or dropping $20 for chicken wings and fries from McDonald's. Like they're known to be affordable food. Right? So what if they just like own all of the like white labeled food that's being sold at the stadium?
Okay, that's an interesting theory. I don't know, but what is already confirmed is that there's a flagship McDonald's restaurant that will be built in the stadium. And Chicago currently that's where McDonald's started, I believe, and they have a big flagship McDonald's that has food products that aren't available everywhere else. So they might be doing some exclusive stuff. I don't know if they'll do the white labeled stuff, but that stadium itself, the restaurant in that stadium might have some,
Do you think they'll have like exclusive like McDonald's items?
We've seen at Kentucky Derby, we've covered this, and also the U.S. Open, they have exclusive kind of premium products. Could there be like caviar on like a McDonald's chicken nugget or something? Like,
I'm gonna eat some caviar and I'm gonna drop $50 for caviar and like my little McDonald's
some
chicken
luxury
nugget.
McDonald's stuff.
Honestly,
I think that's possible.
If you guys have had McDonald's anywhere in Europe, that is pure luxury. It's
much better than the
States.
States.
It's so much better. Honestly, I have a buddy of mine who every single country that he goes to in Europe, he goes and eats at the McDonald's first, and he like compares like which one's better than.
I know that they have like specific food based on the region.
The region as well. Yeah. Like Barcelona, fire McDonald's.
Wow. Okay, well, we'll have to try that next time we're on a business trip in Europe. And I say next time, our first time, I guess.
Yeah, and at the same time, we got to go to McDonald's Park at some point when it opens and try it out.
100%.
And then we got to compare the white label chicken nuggets
if
to the
that's
McDonald's
a thing.
one, and if they're the same, then I could be right.
Okay, we'll test that theory and we'll document it. That could be some cool social footage right there.
Yeah, that would be
social content.
Some social footage for sure.
In the world of M&A and major investments, 2 pieces of news. We'll fire through them quickly. One, PSA, the biggest name in the trading card, collectibles, and grading business, is getting a $200 million injection from its parent company, Collectors, over the next 18 months. So the reason for this, the industry has never been faster growing, and there's never been more demand to get these collectibles and trading cards graded. PSA is hiring more than 1,000 people, doubling their physical footprint. Their customers, the cheapest tier for customers, is taking up to 7.5 months to get something graded, which is wild. Right?
Yeah.
So they graded 2 million cards in 2020. They're on pace for 27 million this year. And since 2021, Collectors has invested 100 million in PSA, opening up new facilities in New Jersey, Tokyo, Florida, Texas, essentially roughly tripling PSA's staff. I think this is fascinating. We wrote a piece on this a while ago, kind of the state of the union of the collectibles industry. We talk about this concept called kidults, where people that grew up, roughly like Gen Z, millennials, that grew up consuming this vintage historic IP, like everything from Pokemon to vintage Super Mario games to
sports trading cards, Tops,
right?
Or
there's roughly $23 trillion of spending power that's moving to this demographic that now is obviously they're adults now, but they have this childlike nostalgia and they're spending on this stuff.
It makes sense because we know these are real assets that have value, right? And so, people have actually like invested in collectibles as a hedge on inflation.
100%.
And so at the same time, there's also major trends with digital pack ripping where there's a high frequency of transactions that are happening in the collectible space. And at the same time, that's continually increasing demand for these cards, especially not even from the consumer, but for these platforms that need to have all these cards in store in order to, continue these digital pack ripping apps that are popping up.
So it's funny you mentioned digital pack rippings. I was going to say that. So I had a Twitter exchange with Olivia Moore, who is a consumer investment partner at Andreessen Horowitz, just this past week about the digital pack ripping phenomenon. And she talks about this and the details, kind of the phenomenon that's happening and some of the stats happening around this. So we know some of these platforms, they're great at your pack rip. It's kind of like gambling in a sense and gamification.
Yeah, gamification of pack ripping.
So you pay, essentially the concept is you pay a certain amount of money and you get to rip open a personal, like kind of a digital pack. And it's a real card that's either it can get shipped to you, you can vault it, or you can sell it back to the platform for 80% of the fair market value. It's interesting. It's kind of like betting to see if you can get something more valuable, generate some alpha, and
and it's like it's really about like getting that chase card. Like there's always that PSA 10 card that everyone's chasing, and so they're willing to sell back all their other cards for 80% of the value in order to continue to have more rips to a point where you can get that chase card. And at the same time, all of these apps are making money off of getting it back for 80% of fair market value. And so they're all popping up. They're actually cash flowing machines.
Yeah.
And at the same time, they're accelerating demand for collectibles overall, especially for younger people who are just getting into the game. Like that's their first touch point or gateway into it.
I mean, we have a lot of friends in the collectibles industry, but Olivia, whenever we have guests, please come on. This is an open invite. We'd love to talk about this phenomenon and all the other stuff around collectibles, media, entertainment, consumer. I think there's a bunch we could talk about. The next piece of piece of information that I wanted to talk about within the M&A and investments for this week is the youth sports industry is worth about $40 billion, and a group of senators just declared war on the sports asset class, basically saying to private equity folks that you are not allowed to invest in youth sports. So Chris Murphy and Cory Booker dropped the Let Kids Play Act, a bill that would literally force private equity to sell every rink, league, and tournament platform they own within 2 years and refund parents. Personally exposes GPs, general partners at these funds, to $1 million fine and jail time for lying about it. Any PE fund that invested in youth sports is automatically presumed a vulture investor, and they get 60 days to sworn a certificate of rebuttal. I don't know. This is interesting. Designated firms get 2 years to divest ownership and management rights. This is wild.
It sounds like a very drastic punishment where I don't know if this even holds up in court. I don't know exactly like what grounds you can to regulate this in this type of way.
Yeah.
So I think there's going to be a lot of complaints coming up about this because, I mean, Sid and I are in the sports space. We are in constant discussions all the time with people that are actively investing in sports, and they do see youth sports as a real investment opportunity. You can look this up. There's so many articles that have been written about it. I've written about it actually because I think there's a huge opportunity in the real estate space and actual luxury experiences around youth sports tourism, because that's a big market overall as well as a subcategory of youth sports. Now, I'll give you my take on this.
Yeah.
I'll make it brief as well. I think that there are good and potentially tough consequences that come from private equity coming into youth sports. The original ground was that youth sports is, traditionally run by mom and pop shops, but not only mom and pop shops, a lot of it was driven by volunteerism, right? It's your parents decide to run the little league for their kids. But here's the thing, as professionalization trickles down, right? And sports has become a real outlet for people to essentially make their careers out of. I mean, we see this all the time with emerging leagues, things like League One volleyball, which is now creating a pathway for, young kids who are getting into volleyball to have a professional platform where they can make a living off of this. More parents are willing to spend more and more money for the best type of programming. But at the same time, you have to professionalize it in some way, and that requires capital. And that's why private equity was coming in the first place. What the big concern is that they're verticalizing youth sports. So it's not just, hey, we're going to own the hockey rinks or the fields. At the same time, we're going to own all the jerseys. We're going to own the streaming platforms. We're going to own all the scheduling and all the software behind it. And so because we own the entire vertical overall for each sport, we can now charge even higher prices. And we know that families are willing to pay for this based on, the consumer data that they have. Oh, these are all wealthy families that are willing to spend $40,000 to $50,000 a year on their children's sports. Now, I do think that type of margin expansion might be tough, but at the same time, you're going to need continued capital to come in and professionalize the space entirely. Maybe there's some regulations or in-between move that you could do, but overall, I'm still honestly for more capital being deployed in youth sports because I think there's a huge opportunity and there's a lot of demand for it. People are willing to pay for the best program.
No, I agree. And I'm not sure if this will go through. This is the second time in the last month, we said this at the top of the show, that senators in Congress are making a push against wealthy individuals and investment groups within sports. The Home Team Act last month that we talked about in one of the prior shows that Bernie Sanders introduced to prevent billionaire team owners from moving professional sports teams to a different city after acquiring them because the local citizens and taxpayers help prop that team up. So I think it's interesting. Some have more merits than the other. I think with this as well, it seems pretty extreme. Yeah. I think that's a good thing that there's more private money coming into youth sports and professionalizes a lot of it.
And that actually might encourage
infrastructure.
Exactly. And that might encourage public funding as well, right? We're seeing with like Motown Sports Village, there's a chance that they might actually get public financing for all of those, sports infrastructure with, hundreds of fields, hundreds of courts for people to play in. At that same time, it's a $3 billion project that might require public funding, similar to how sports teams need public funding for their stadium development within, these states. I think that could be the same thing for youth sports. And then there's some form of subsidization that's going on, at least for like the real estate, like sports infrastructure level. Now, the vertical plays, that's a different story. And I think there potentially could be some solutions for that.
Yeah. In the world of new fund alerts, we have 12 weeks.
And this was a buzzer beater, too.
This was a buzzer beater. We were coming into this show with no new fund alerts, and we were about to do the womp, womp, womp sound effect. And producer Pablo, we told him to change it last minute because we saw a headline that Shamrock Capital closed its fourth content strategy fund. Content 4 is the name, at $813 million in commitments, oversubscribed and well above its $700 million target. Fundraising wrapped up in just over 3 months, shows a testament to how well that team and firm is run. So they are investing in premium cash flowing generating content and media businesses across music, film, TV, sports, gaming, and creator economy. The same playbook as predecessor funds. Anything else you want to add to this?
Yeah, I mean, they bought Taylor Swift's Masters a long time ago. Remember when they bought it from her and then she re-released it, and it was like a studio recording. That was a whole debacle. But let's be real, like this content strategy works. A lot of this IP that they buy, it's very strategic assets that over time become even more and more valuable. They're going to do it across sports and entertainment, and I think this is just a very safe investing strategy where you can drive real returns.
Yeah, no, I agree. Congrats to the team there. Excited to cover more of the investments you guys do. Emerging league news. So this week, the Professional Women's Hockey League, PWHL, awarded its 12th franchise to San Jose. Okay, we talked about this. We covered them basically saying they're the fastest growing a few weeks ago, that they're the fastest growing emerging sports league. They've just reached 1 million fans, the fastest it's ever been in a single season. And here's the interesting thing. This is the 4th expansion team announced in a single month and officially doubles the league from 6 teams to 12 teams in under 3 years. It's one of the fastest growing scale ups. It's owned by Mark Walter, one of the sports kind of ownership juggernauts. So there's not team ownership is not being sold separately right now. They just crossed 1 million fans this season, like I mentioned. YouTube viewership is up 77%. We posted the one clip on social media and it went nuclear. Everyone said they attended.
By far, some of the most engagement we've gotten.
Yeah, some people said everyone liked it, thought it was interesting, liked the concept for the people that have actually tuned in, and some people have actually went to these games at MSG or TD Garden, and they were like, it was an electric atmosphere.
Yeah, and one thing that they've done a really good job on is making sure they're distributing on YouTube so everyone can watch. This is the new trend that emerging leagues should really take advantage of. Make sure that your content's actually accessible at first so you can build your fan base. Maybe long term you can do a broadcast or streaming deal, but we're seeing comments. They're like, look, we love that it's on YouTube and I can actually watch in and tune in.
The YouTube chat, they said, was like very interactive. Fans are communicating, talking to each other. So I think it's...
At the same time, I think you just keep that. And then at some point in time, when the economics make sense and a lot of these athletes need to get paid, you need to get a major or media rights deal happen, then you can go work with the streaming or broadcasting platforms. But build the fan base first, which I think they've done a great job on. And shout out to any of the new players that are playing for San Jose. Huge. Because you can make a lot of great tech investments there. That's what it seems like. So.
Yeah, it seems like that's it's right near Silicon Valley. So following the Warriors playbook. Okay, in the industry spotlight, not that he needs it, but if you've been anywhere near tech Twitter and sports business Twitter, They've kind of been saying the same name. Stan Kroenke, one of the GOATs in team ownership.
A legend.
He is most definitely a legend. He has a combined $23 billion sports portfolio, single most valuable sports empire in the planet, ahead of a lot of others, including the Jones and Harris Blitzers empire. Congrats to him, because one of his assets, Arsenal, finally won the Premier League for the first time in 22 years. Huge. I like that. I like that new sound effect. That's
what? Suey?
Yeah,
I'm gonna. Hey, that's what Speed and KSI say it. So it's kind of funny.
No, you have to say it the right way. It's like see. Yeah, I like that. I like the Cristiano Ronaldo sound effect. But anyway, I'm gonna quickly list off of his portfolio. If you don't know, he owns the LA Rams, valued at $10.43 billion, third most valuable team in the world behind the Cowboys and the Golden State Warriors. Arsenal FC, Premier League, Denver Nuggets, the 2023 NBA champions, Colorado Avalanche, which is their NHL team, Colorado Rapids, which is the MLS team, Colorado Mammoth, which is the National Lacrosse League. Plus, he has SoFi Stadium in Hollywood Park, Ball Arena, the Altitude RSN, esports franchises. Sportico valued his entire sports portfolio at $23 billion. And CNBC said he is the number one sports empire amongst who I just said as well. Kroenke is also the largest private landowner in the U.S., which is kind of wild.
Yeah. So I got to say one thing and one thing only. This dude in the 2020s has been an absolute winner. If you've looked at just the past 5 years, you have the Arsenal win. But at the same time, the LA Rams won in, I believe, 2022. They won that Super Bowl, the 2021-2022 season. At the same time, the Nuggets won 2022 to 2023 season. Mm-hmm. And then now you have Arsenal winning.
He's just a winner.
Yeah, he's just a winner. And honestly, the LA Rams, they could win this year. They look pretty good. Honestly, they were very close to making the finals or Super Bowl. And let's be real, if it was Rams versus Patriots, the Rams would have probably won that.
Wow.
So great assets that he holds in the sports space.
He also has a 940,000 acre New Mexico ranch land, and that's twice the size of Delaware, the state of Delaware.
Wow.
Just for fun. Okay. In the world of startups and technology, we'll rip through this quickly. A new startup story that sits at the intersection of collectibles, luxury, sports, IP, and frankly also chemistry. Arsenal Football Club just launched its first ever diamond collection, and they aren't sourced from a mine. Okay, who cares that Arsenal did a diamond collection, whatever. They're lab-grown diamonds that are made from the carbon pulled from the actual grass on the Emirates Stadium pitch that they play on. So startup behind it is called Brillianto, a Spanish lab-grown diamond company, and they've turned a football club's home turf into wearable, ownable IP. They created 1,866 pieces, one for the founding year. It's the perfect case of how clubs are using their own IP to create cultural moments that are also luxury assets as well. And the diamonds are like lab grown from carbon extracted from the grass of the Emirates Stadium pitch, like I just mentioned, then purified and crystallized under high pressure using renewable energy. Seems like a pretty cool use case of the startups, right?
Yeah, absolutely. I mean, it makes sense because you're adding another layer of wanting to buy Brilliantos. Diamonds versus anyone else's diamonds. It's a real
producer Pablo's dying in the corner.
I mean, it's a real it's really distinguished because also the diamonds like have the Arsenal cannon, and so there's a clear like appeal there as well. One thing that I didn't realize is that actually their luxury hospitality club at the Emirates Stadium is also called the Diamond Club. So wow. It's very much like in the heart and the cultural zeitgeist of the Arsenal Stadium. I think that
for sure.
This is pretty awesome. I looked, it was like, I think like 1,200 pounds to get this diamond chain. Shout out to Kai, courtside partner. You should buy this chain. It actually looks pretty clean. So
it does look cool. Okay. Last thing I'm going to touch on before I give it off to you, Professor Piermanu. In cool partnership news, Amex just became the official payments partner across Fanatics' ecosystem. They're the presenting sponsor for Fanatics Fest. That's later this summer in July in New York City. The headline is that they're also a new co-branded Fanatics American Express credit card partner. Amex and while I was at Fanatics, I knew of this, but now it's kind of public. Fanatics is launching a credit card later this year for fans to earn points called Fan Cash so they can use it across the Fanatics ecosystem. Basically built for sports fans.
Yeah.
Amex said nearly 80% of its card members call themselves sports fans. Fanatics has over 100 million of those in its portfolio or in their database. So it's two giant rewards ecosystems basically fusing together. So the card itself is not issued by Amex. It's issued by First Electronic Bank and managed by Imprint, and then the railways that it operates on, the network, is Amex. Similar to how Delta and Marriott and kind of those co-branded cards work as well.
Yeah.
And we know a lot of the folks on that team, so I'm sure we'll do a proper breakdown and recap of and kind of in-depth analysis of the Fanatics credit card closer to when it launches.
Yeah, I mean, I think this makes sense. A no-brainer because let's be real.
A no-brainer. I like that. Maybe we should add that for
that should be a sound.
No-brainer or something like that.
I mean, let's be real. Fanatics holds probably the most valuable fan data. And at the same time, now you're going to have another touch point for that data, right? Yeah. Transaction data is very, very powerful. Especially a lot of these credit cards have like huge ad networks where they're able to leverage that data for more targeted advertising. That's super powerful for Fanatics because now they're tapped into the fan ecosystem like never before. Outside of just their ecosystem, they now get access to those data points, right? Because let's say you're using the Fanatics card at an NFL game, right? Or an NBA game, or you're getting like a hot dog or something, right? Like they know what you're buying because you're using that to collect rewards, right? I mean, that's the natural name of the game for credit cards. And it just makes sense to do that, especially given how valuable fan data is. We know this all the time. We talk about the invisible data problem that sports teams and leagues are dealing with. This is a good way for Fanatics to tap in and be one step ahead of the game.
Professor Paramanu, teach me AP prediction markets this week. Give me a quick rundown. Don't bore me to death here.
Okay, so Professor Paramanu in the cut.
I'm
going to make this a little bit more cultural because, I mean, the way that we've been doing this, it's been a breakdown of the latest news. But I figured, honestly, prediction markets is getting a little bit complex. And the real reason why that I think about this is because of this huge Twitter tirade that we've seen the past week from Matt Kalish, who's actually a legend in the sports gambling space because he co-founded DraftKings. He's the former president. Now he's working on more in the creator economy space with Hardscope. But essentially, there's been this, huge debate going on with gambling products versus prediction markets. Obviously, people who operate prediction markets are anti-gambling because they're built an exchange that is more friendly to the retail investor, while sports books are actively, essentially, they're the house betting against the retail investor. So that's this whole dynamic. And so he tweeted, and look, he had like at least 1,000 tweets, but this one tweet caught my attention, and this is what I want AP prediction markets to be about. So
let's hear it.
He said, it's talking about prediction markets. It's currently an extremely niche product where only the 1% know what the hell is going on. Excuse my language. He says way worse stuff, curse words that's thank God it's not on this tweet.
It was actually very entertaining.
Yeah, it was very entertaining
to watch that.
And that's why only 3 types of people engage in the conversation. 1, professional gamblers. 2, professional market makers. And 3, employees, investors, and exchanges, or people making derivative products. So that's none of us, but I've tapped in, done some research, and I actually just want to break down what prediction markets are, the difference between sports gambling products, touch upon it, and then in future editions, we'll break down really interesting products that's really in the discussion or the zeitgeist of that week. Does that sound good?
That sounds good.
Okay, so a prediction market. Now, a lot of people kind of understand what it is, right? You're making a trade on an outcome that can happen, right? Whether it's in sports where, hey, look, I think the Rams are going to, or is the Rams going to win? Yes or no? You can make a trade on the outcome, whether it's a yes or a no. There's a probability that's assigned with each outcome. So, for example, if it's a line, typically like a sports betting line, it'll be a 50% odd, 50%, right? Now, if you go on Kalshi, you're going to be like, wait, it doesn't give me percentages, it's giving me cents, right? That cent, or like 50 cents for that trade, is essentially saying if I, spend $1, I'm going to make $1 based on that 50-50 outcome, right? Essentially plus 100. And so with the difference between prediction markets and sports gambling products, and this is the main distinguishment that I want to make, is that with sports gambling, there's a line that's set by the sports book. They have odds makers, guys like Sports Radar and Genius Sports. These are third-party middlemen that essentially make the decision on what the line is going to be. Now, it's not going to be exactly accurate because sports books want to make a margin off of every trade, whether the bettor on either side is a winner or a loser. So that's called a VIG, or like a 4 to 6% margin on that engagement. So what they're really looking for is action. They want people to say, oh, look, that's a really interesting line that I want to hit. Let's do it. While prediction markets are a little bit more accurate in regards to their lines because it's essentially the wisdom of the crowds. There's multiple players within a market or a prediction market because it's based on an exchange, right? You have two parties or you have two essential, like you have a bunch of different parties involved, whether it's retail investors and then the market makers. Does that make sense? Do you have any questions on what I've just said?
That makes sense.
Okay, so sports gambling. Essentially, you only have two real parties. You have the house and you have the retail investors, right? You're essentially going up against the house. Now, exchanges are considered peer-to-peer, so you're going up against everybody else. If you think about a stock market, that's kind of how it works, right? Think about a derivatives market, right? If you're trading options, there's a buyer and there's a seller. So you're up against one other person, but at the same time, there's multiple parties that can get involved in the action, right? And so with prediction markets, there's these things called market makers. And this is what I want to make the big distinguishment because a lot of people don't understand this. If you look at a market that just started, that just spawned, okay? And let's say it's me and you, okay? And let's say it's a trade on the Falcons, whether they're going to win the first game. Now, let's say I'm like, okay, I want to buy this contract at 23 cents or 23%, okay? But you're like, I'm only willing to sell this contract at 30, right? You can't make that match. In order to make that match, you need a market maker who's willing to set the quotes for you. And so a lot of these are like hedge funds, quant trading firms, guys like Citadel and Susquehanna, right, or SIG. And so a lot of the conversation or discourse on prediction markets is about how they're the ones that are generating liquidity and they're actually making money by setting up the best bid or setting up the best ask in order to get a margin on that trade. And the way that Kalshi makes all their money is that they have fees on each trade. So what they really care about is not who wins or who loses, but actually how many trades that are occurring. So at some point in time in the future, we'll break down why certain, advanced gamblers, like hedge funds or active traders might not actually be beneficial for Kalshi based on their trading mechanics because they might just do one bet and then pull out when they see that there's a hole in the market. And that's the same thing that sports books do where they ban them because they're like, look, you're, essentially betting against the house in an unfair way to the house because they're not making money from it. So that's kind of the distinguishment between sports books and prediction markets. It can be a little bit confusing, but each session I'll break down it a little bit more in depth.
That was a great intro class for me. I feel like and for people, I think that's a good distinguishing thing. Are you going to give Professor Paramount, are you going to give quizzes out or no?
I think
Any
I might
pop
give quizzes. I don't know. It depends. I think I'll give a pop quiz to Pablo tomorrow.
Producer
like,
Pablo, you better
what's a market maker? But this is really important because you're going to see a lot more dialogue on this. There's so many regulators that are involved. You're going to see guys like Matt Kalish who are big sports gambling proponents who are going to defend sports gambling against prediction markets and the other way around. And so we're getting more closer to what this is going to look like in the future. But I want you guys to know and actually understand what's happening and what people are saying.
And there's so much action in the market that's happening in developments that I think this segment of the show will be really interesting for us to cover. I think we can move it up later or earlier in the show. I think there's more that we can do, make it more engaging physically. We've already talked about different things that we're going to do. So I'm super excited. I thought today was really good. Still strong going. We're consistent. That's the biggest thing. Social media is reflecting that. We've reached about 700,000 clips from the long form. So I'm happy, man. I'm glad we're doing this.
Yeah, a lot of people actually, my mom is saying that we should be linking our YouTube channel to the socials. So
we haven't technically launched it.
Yeah, we haven't really launched.
But I think we should. I guess as more people find the fourth quarter, they should also get exposed to our newsletter, I feel, and our YouTube.
Yeah, absolutely. So that's like the next thing that we got to do. We're figuring out when we want to launch this because I think we're close.
We're close. Thanks for tuning in. Thank you, Professor Paramanu, and thank you, Producer Pablo and Pilot Pablo. We'll catch you next week.